So anyone who is joining new today, please go and check out our previous sessions, the first 3 sessions, where we discuss about the key financial statements, namely the income statement, balance sheet, and the cash flow statement. And we also discuss about the key performance indicators, the key basic ratios that one should look at when selecting shares. So this is the 4th session, as you all know, but I'll just give a quick recap of what we discussed. So as usual, I will be going through the fundamental analysis of this presentation, followed by the technical analysis done by Mr. Saliya. So we discussed about the income statement, and we learned certain key basic ratios that one should look at when investing in shares. So this included profit margins, earnings per share, which is an important indicator, and the price earnings ratio. So we discussed the interpretation part of it in the first session. In the second session, we looked at the balance sheet analysis, and we learned a few ratios which are calculated using the balance sheet. So you calculate net assets value, price to book value, and debt to equity ratio. So we have again discussed the interpretation of it. Anyone who have missed them, please check out our first 3 videos available on SC Securities YouTube channel. And last week we discussed about the cash flow statement, and we discussed about some profitability ratios. So these profitability ratios included return on equity, which is very important, and return on assets. So both these are 2 main profitability ratios that have been widely looked at by investors. So in today's session, before we start, I just want to summarize all what we have done. So basically, by now you know what are the key performance indicators, or what are the key ratios that you need to look at in selecting a share, right? So in addition to these financial factors, you also need to look at non-financial factors as well. So when you're selecting a share, you need to see whether there is high growth potential in that company. Is that business in a growing industry? Is it a declining industry? And among the peers, how are they performing? What is their market share? Likewise. And as you learned, as we discussed, we need to look at their price earnings ratio. You should select something which is relatively low with high growth. Then relatively low price to book value. ROE should be high, and return on assets should be high. And just see whether it's a dividend paying company and whether that dividend yield is high enough. So these are a mix of things that you need to look at, but based on investor preferences, based on the risk appetite of investors, these decisions can change. Okay, so I'm going to touch upon few things. Basically, I would name them as rewards for investing in shares. So in our future sessions, we will be going into detail of this. So today would be an overview of those rewards, what you can get by investing in shares. The main reward that anyone would know is capital gains. So what is a capital gain? Capital gain is simply you buy a particular share at a specified price, and in future you sell the share at a price which is higher than the price which you bought. Very simple, right? So this can be in shares, this can be in land, this can be in gold, this can be in forex, right? Any asset class. If you buy at a low price and if you sell at a higher price, you get a capital gain. One important thing about capital gains made out of equity investments is that capital gains made out of equity investments are tax free. There is no capital gain tax for share market capital gains that you make. Now, capital gains tax have been introduced by the government, but it is not for shares. It's applicable for land and property transactions. If you buy land today at a particular price, and if you sell with a capital gain, you need to pay a tax for that capital gain you have made. But in the case of shares, capital gains are tax free. So capital gain is one of the main rewards that you would get, and that is the most widely discussed reward. In addition to that, let us look at a few other things. Now, there's something called rights issue. Most of you all would have heard it. Now, what is a rights issue? Rights issue is where a company, when they want to raise new capital, they can offer new shares to its existing shareholders based on the number of shares they hold in a particular ratio, right? So the most important things are, it is for the existing shareholders based on the existing shareholder. A rights issue is when a company offers its existing shareholders the chance to buy additional shares at a specified price. And most of the time, these shares would be offered to the existing shareholders at a discounted price than the current market price. For example, we'll say the current market price of company A's share is 100 rupees. The company may offer the rights to its existing shareholders maybe around 80 rupees or 90 rupees, which is at a discount. So this is an encouragement and an incentive given to the existing shareholders to invest in the company. So when you have bought shares and when the company comes up with a rights issue, you are given the right, you are given the privilege to buy more shares of the company at a price which is less than the ongoing market price. If I refer to the previous example I took, current market price is 100 and the rights issue is at 80 rupees. So you can pay 20% less to buy new shares of the same company. So it can be in different ratios. It can be 1-to-1. If you hold one share, you can get another share at a discounted price. It can be 1-for-2, right? If you have 2 shares, you get 1 share, likewise. So when a rights issue is announced, there are certain other things that you need to look at, such as calculating the theoretical exercise price, which I will cover in detail in a future session, right? So I hope the idea of rights issue is clear to all of you. Then the third type of reward is that you can get dividends. Now again, most of you all know what is a dividend, right? But for the benefit of those who are new, I will just give a brief introduction. Now, dividend can be paid in 2 ways, either as a cash dividend or as a scrip dividend. So as the name suggests, cash dividend means that the company would make a payment in the form of cash to the existing shareholders, right? It's a payment made by a company out of its earnings in the form of cash. Okay, so when the company makes profits, they would like to share a certain part of their profit with its shareholders. Now remember, shareholders are the owners of the company, but not that all shareholders can manage the company. Therefore, shareholders appoint a board of directors. So it is at the discretion of the board of directors to decide whether to pay a dividend. Shareholders can't demand for a dividend. The board of directors will propose a dividend and the shareholders have the right to approve the dividend. That is how it works. So a cash dividend is where you get a cash payment from the company based on the number of shares you hold. For example, we'll say that there's a particular share which is trading at 100 rupees and you are a shareholder of that company and that company is paying an 8 rupee dividend for a share. So for 100 rupees share you hold, you get a cash payment of 8 rupees in the form of dividend. So as a percentage return, you have got 8% return from your investment only in the form of cash. So this can be in addition to the capital gain that you would have already made. Now, normally what happens is when a dividend is announced, the share price also starts to move up, right? So your total return would be the dividend what you get as well as the capital gain that you would realize due to the increase in the price. So that's about cash dividends. The second form is scrip dividend. So scrip dividend is mostly announced by companies when they don't have sufficient cash to pay a cash dividend, or certain companies pay a combination. This comes as a bundled offer, especially banks. Most of the banks, when they pay dividend, their dividend has 2 components, a cash component as well as a scrip component. So when companies want to retain most of their cash, and maybe distribute some of their surplus profits which they have made in the past, they can use scrip dividend. So in scrip dividends, what you get is not cash. What you get is more shares of the company, right? So as I have mentioned here, scrip dividend, the firm issues its own shares to stakeholders in the proportion to the number of shares held in lieu of cash dividend, right? So it says in lieu of cash dividend, but in reality, it can be a combination of cash dividend as well as scrip dividend. Now, how are these new shares being issued? Now, in the case of rights issue, when new shares are issued, you have to make a payment for it. In scrip dividend, shares are issued by capitalizing their reserves. Now, equity of a company is made of the share capital invested by shareholders as well as the retained earnings and other reserves which are retained in the company. So when you say reserves, it includes, when you say equity, it includes share capital and reserves. So what they do in the form of scrip dividend is they convert part of their reserve into share capital, and those new shares are being given to the existing shareholders as a reward in the form of a scrip dividend, right? So, okay, what if the shareholder doesn't want, sorry, what if the shareholder wants cash and the company is paying only a scrip dividend? Yeah, so you have the option of selling the new shares, what you are getting, to convert it into cash, right? So there are different theories that I can teach in terms of dividends, but I don't think that all those are relevant here. So mainly what you need to know is what is a cash dividend and what is a scrip dividend and the difference between them. So in future sessions, I'm going to again cover dividends in more detail and calculate certain ratios that are used when you're making your investment decision. Another form of a reward is subdivision of shares, right? Theoretically, this is not a reward, but however, due to the investor perception, right, this can become a reward to you. So what is subdivision of shares or share split? It is basically a company divides its existing shares into multiple new shares to improve the stock's liquidity. There's a share which is trading at 1,000 rupees and the liquidity in the market is very less. Therefore, this share is not regularly traded because of its high price and lesser number of shares. So to improve the liquidity, what the company can do is they can split the share into more shares. So it's the same old share that is getting split into a higher number of shares. So if you take for an illustration, 1,000 rupee share is being split into 10 equal shares. So one share is getting split into 10 shares. Current market price is 1,000. So if you divide it by 10, theoretically, the price after the subdivision should be 100 rupees, right? Theoretically, that's it. And there's no new value created by the company to its shareholders. It's the same share, right? You just had one share, now you have 10 shares, which are of 1/10 of the original price. That is how it should be theoretically. But based on past experience in capital markets, what we have seen is that each time a company announces a subdivision, the share price starts to move up. So that's why we say it's a reward, but theoretically, it is not a reward. There's no return to the shareholder in theoretical terms, right? But because of the sentiment, it can drive up the share price, right? People who are investing, who are familiar with the market would know that in the recent past, there were several companies which announced subdivision of shares. And you all very well know how the share price became. Again, when you subdivide or when you split a share, there's no value created to the shareholder. What it does is that it increases the liquidity of the share, right? However, in our local markets, people can benefit out of these share splits. Okay, so this week I will stop with that, and I will now call upon our technical specialist, Mr. Saliya Gamagedara, to take over. Saliya, over to you.
Thanks, Charitha. Okay, good evening, everyone. Uh, Thank you once again for joining us. And today I'll be taking you all through the candlesticks. We were talking about the trends, then the support and resistance. And it is important for us to understand the candlesticks, because I think even last week, some of our friends, participants wanted to understand how to study and interpret the candlesticks. Now, this is just a drawing that I did just to go through this, and then we'll hopefully take you all through an example. And I would be interested in showing you the current status and the forward expectations of Expo Lanka purely based on candlesticks. Okay, so when it comes to candlesticks, in fact, there are about 13 important candlesticks that we need to kind of, understand. It's, when it comes to single candlesticks, you have patterns, and I'm talking about those. And those 10 are basically, those 13 are the ones that I'm going to share with you. There are 5 bullish candle, single bullish candle patterns, and 5 bearish. Now, when it comes to these 2 candles, these are known as the normal candles. The reason as to why it's normal is because you have the wicks and the body, right? These wicks are also called shadows. So I'll be, interchangeably, I'll be using wicks and the shadows. These 2 differ is due to the open, high, low, close values that we take into consideration when we study the charts by using candlesticks, and also, some other charts like bar charts. In the case of candlesticks, we use the open, high, low, close. Now, the difference between these 2 is that when it comes to the high and the low, it'll be the same for the bullish and the bearish candles. But there is a change, and a valid reason for that change when it comes to the body of the candle, of the 2 bullish and bearish candles. Now, last time, when we were just going through the candlesticks, I mentioned that the colored section, colored box over here is called the body. Then, as I mentioned, the upper little line that you have on either side, are called either the wicks or the shadows. Now, when it comes to, let's use the open, high, low, close values to understand what it is, how relevant it is for us to understand the significance between the bearish and the bullish candles. In a bullish candle, the reason as to why we say call it a bullish is because we can see that when we start the day or the session, it opens at the bottom of the bottom of the body, right? And then what happens is, in this normal candle, the price comes down to make a low, right? So we take this low here. The price opens the session, comes down to make a low, and then it increases, moves up to hit a high over here at the top of the shadow, to close above the open with a considerable distance between the open and the close. In the case of the bearish candle, the open is at the top, of the body. Then it goes up to hit a high, record a high at the top of the wick. Then it comes down to make a low. Thereafter, closes below the open price and closes above the low price, right? And that is called the normal candlesticks. Now, I mentioned apart from these normal candlesticks, right, there are 4 other bullish and bearish candlesticks that we have to be mindful of when it comes to the basics of candlesticks. One is called the most bullish candlesticks. The most bullish are like this, meaning you don't have the wicks, you only have the body. What does that mean? The open of the body is at the bottom. At the same time, the low is also the same. So open and the low equals. The close and the high also equals in a bullish, the most bullish candle. You know, the day or the session starts at the same price, meaning the session opens at the same price as the low price, fluctuates within the session to hit a high, which is also going to be the close. When it comes to the bearish, most bullish candle, opens at the same price as the high, fluctuates within the session, closes at the same price as the low, right? We see these types of candles either in bullish and bearish markets for the overall market and also individual stocks. Then the next second most bullish candle is something like this, right? Something like this, where the high and the close will be the same, close and the high will be the same, but the open starts at the bottom of the body, the low is fairly at a distance from the open and from the body also, right? So what happens here is that opens a session at this level, then retraces to hit a low, thereafter rallies up to make a high and to make the close equal. This is the second most bullish candle. Conversely, the second most bearish candle will be when, incidentally, we must understand that whether it's the body is shorter or even longer like this, as long as there is an equal close and a high and a difference between the open and the low are considered the second most bullish candles, right? It can be, the distance can be like this, it can be, you know, something like this, or even here, or even here, wherever, as long as the close and the high are equal, where the open and the low are different. This is the second most bullish candle. Similarly, when it comes to the bearish candle, the close is here, the low is here, which is equal. The open and the high will be different, right? So what's the thinking behind it, right? In the case of this, the bullish, second most bullish candle, what happens is it opens at the bottom of the body, retraces down, goes up, and closes at the same price. Here, opens, goes up, retraces down, hit a low at the same price as the close. And this distance also can vary like this, but as long as there is a distance between the open and the high, and no distance at the close and the low, it is known, it is considered as a second most bullish candle, right? Then you have the neutral bullish candles. The neutral bullish candle will be something like this. I would say something like this, where the distance of the body is short, but there is quite a distance between the two shadows. So what happens is it opens, retraces down, and rapidly rallies up to hit a high, but then closes, retraces back again to close a little above the open. Right here also the same thing. Where it opens, rallies up, hit a high, retraces down, hit a low, and closes a little below the open price. This is called a neutral bullish and bearish candles. Then the least bullish and bearish candles will be something like this. They are the least bullish. This is the opposite of the second most bullish candle. Here it opens at the same price as the low, runs up to hit a high, but once again retraces down rapidly to make a close a little above the open, right? This also, just like that second most bullish candle, the distances can be varying in size, you know, right up to anywhere here, something like this. As long as the close and the high is has a difference, or rather a distance, and the open and the low has to be equal, then it becomes a least bearish, rather least bullish candle. Then the next thing is where the open and the high will be equal, but there is a distance between the close and the low, right? The close is here, so opens at the same price as the high, retraces down, make a low, and rallies up to make a close with a difference. This is the least bullish candle. Then you have these three candles, which are known as doji candles. In other words, these candles don't give you a real direction, right? Because you have the open and the close at the same price. High and the low this way. The thing is, you know, you really don't know whether it opens, goes up and comes down and closes here, or opens, comes down, goes up, closes here. You don't know, right? Well, that's why there is no direction as such in a candle like this. Now, this is a bearish, you know, just by looking at it, you can see that this looks a bearish candle in nature, which is also known as a gravestone candle. See that the open, the low, and the close, open, low, close, all equals except the high. Whereas this is a dragonfly, where the open, high, and the close are equal, but the low is different, right? So basically you have the most bullish candles second most bullish candles, the normal candles, then you have the neutral bullish candles, the least bullish candles or bearish candles, and these indecisive 3 candles. Apart from these, you have shorter versions of the same candle formations like these, shorter versions, right? At the same time, you must understand that there will be, differences of lengths when it comes to any type of candle that I just now described, right? So with this, as I mentioned, I'm going to take you through Expo Lanka here. I'm going to describe some of the candles, and then let's see what is happening right now. Now, in the case of Expo Lanka, as we know, this you can basically see what has happened to Expo Lanka at the top, right? Expo Lanka hits a high of 64.60 on the 26th of January and makes a bearish close. Thus, it's a bearish candle. At the same time, you can see that it's a normal candle where you have a wick at the top, a wick at the bottom. And if you take just the distance, it opens at 64, goes to a high of 64.60, comes down to 60.90 and closes at 61. So from the low to the close is about 90 cents. From the open to the high is about 60 cents. So as a result of that, you almost see like a similar shadow up and down on the candle. Now this one is something that I mentioned about as a least bullish candle. This is a least bullish candle. Here you have a small wick over here, but at the same time, it's something similar to what we see here, right? Where it opens at the same price as the low. You can see that if you look at the OHLC values, opens at 57.50. Hit this is equal to 57.50. The low went up to 62.80, closes at 61.90, right? And then the next day it opens higher, right? So we have to understand, if we are wanting to study the charts, it's not just loading some indicators and trying to sort of buy and sell. You see, that is the difference that we have right now, where we are trying to encourage you all to understand how the prices are behaving within a day or within a session, so that you will be able to make a better informed decision by using the price and volume behavior. That is the reason as to why we are going through and breaking down all these. Otherwise, we also it is much easier for us to just pick up some indicators, show you where to buy, where to sell, and then tell that the basics are fantastic, you can go ahead with it. But in order for us to encourage everyone to understand the behavior of the prices, it's very important. So as a because of you see there is a as I mentioned, that this is a neutral pattern and it's a neutral bearish pattern, right? It's almost okay. These particular candles have their own names. Instead of coming up with those names, right, it is very important for us to get the idea that these are these have relevance, and the relevance is like from 1 to 5, right? The most relevant, most bullish, most bearish is I mentioned, and then the most the least bearish or least bullish also I mentioned. Now from here it starts going up, then it reverses. Thereafter we can see if you take the opens, right, this is the close, close is 61, opens at 55.90. I'm sorry, 60.90, closes at 59.90, then opens at 56.50 and then closes here. But at the same time, you can see another important thing that has happened here. Just like least bullish candles, this is a least bearish candle. I mentioned that the distance of the body is immaterial, as long as, of course, it would have been ideal if we see that the open and the high are similar. But in the case of this, there is only a small difference. But when it comes to the lower wick, which is also considered a tail, right, it gives you a very strong message. What it means is that it opens first, it opens a little higher than the previous day's close. Previous day's close is 55.90. This day's close open is 56.50, right? From 55.90 starts at 56.50, goes up to 57.10, then just shoots down to 42 rupees, but finally closes at 50 rupees and 50 cents, right? So the body where the open and the close has a difference of 6 rupees because it opens at 56.50 and closes at 50.50. So it's a 6 rupees difference. But when it comes to the close and the low, there is a 8 rupee or 8 rupees and 50 cents difference. So the distance was higher. At the same time, if you looked at how the order book in the real market was behaving, you would have noticed that when this is taking place, when it starts at 56.50, moving up to 57.10, what it means is that there were buyers trying to hit the selling side. The buyers were not showing at the bid side, but they were trying to buy from the seller right up to 57.10. Then what happens? The sellers start clearing the buyers, right? From there, right along up to 42 rupees, mostly the sellers were meeting the buyers. They were just selling off to the buyers. You know, at that point of 42 rupees, I mentioned in a support, there is a downtrend and there's a pause for it. At that pause, concentration of buying builds up. This is happening in the order book, not in the chart, right? If you know how to really feel what is going on in the order book, the market depth, or the detail quote or whatever, right? The buy side and the bid side and the ask side, you will realize that at this 42 rupee area, what happens is then you start seeing sellers building up. Rather than selling to the buyer at 42, you will see at 42.50, there are sellers. The buyers are going and hitting 42.50. Then you see 43, so on and so forth. So right up to 50 rupees and 50 cents, most of the time, the fluctuations were towards the sellers getting cleared, thus creating an interest of demand rather than an interest of selling. The next day, what happened? Next day, it closes this day at 50.50. Next day, it opens at 53 rupees. Hits a high of 54.60, right? Then comes down and closes at 51.30. Comes down to 50.10.90 and closes at 50.30, 51.30. So at that point, the next day also, it was bearish. But at this bearish range during that session, right, on the 2nd of February, the low was 43 rupees. But 2 days ago, the low was 42, right? Then there was as a result, there was a rally back up. right? So all in all, end of the day, what is happening to Expo Lanka right now, just by looking at the candles? In the case of the candles, you can see today's candle, right? Now, I said second most bullish candle is when the close and the high equals. The open and the low, there is a difference, right? But here you don't have an equal open and high, but take a look at the open. I'm sorry, the close and the high. Sorry. Take a look at the close. Close is 50-10. Close is 50-10. High is 50-30. Only a difference of 20 cents, right? So it opens at 49.80, comes down. Why? That is significant. Look at 49.80, compare that with yesterday's close, 49.80, at the same price, right? It opens at 49.80, but unfortunately it comes down to 48.60, where the sellers are giving to the buyers, right? Then thereafter, the selling dries out, where the sellers are not giving to the buyers. Little by little, the buyers were trying to clear the sellers, right? And it fluctuates, ends up at 50-10. The close is at 50-10. Now, the previous day, yesterday, right? We can see the close is 49.80. As I mentioned, the same as today's open. Right there again, what happened was the open was 50 rupees and 30 cents. Incidentally, today's high is also 50 rupees and 30 cents. Then yesterday from 50-30, right? From 50-30 comes down. Now the close, I'm sorry, the open and the high here is equal. 50-30 is the open, 50-30 is the high. It's equal. This is the least bearish candle, right? So it hits a high and opens at the same price of 50-30, comes down to 49, settles at 49.80. Today starts at 49.80 with the same bullish momentum, right? Goes up, but then due to comes down to 48.60, but you can see that from 48.60 hitting up right up to 50.30 and closing at 50.10. So 50.30 is an important area for this candle because yesterday's high and today's high are the same. Yesterday's close and today's open are the same. If you go back a little bit further and take this candle, right, you will notice that the open of that candle is also 49.80. High is 50.30, right? And then the low is 48.70. Here the low is 48.60, only a 10 cents difference. As such, this entire range is an important range for Expo Lanka, right? This is not a recommendation to, buy or sell. This is only an encouragement for anyone who is interested to watch this range. Once again, this is not a recommendation for buying or selling. Encouragement to watch. If you all are interested and if you all are, very serious in looking at how to study and benefit out of technical analysis. Remember, I mentioned the workings of these candles, these prices have to match and relate to the happenings in the order book. Because we are looking not or not on, rather, we are not looking on a piece of art. These are not piece of arts. These are real-time information. Real-time information. The difference between fundamental analysis and the technical analysis is that the market is open every trading day. Every market day, the market opens. Therefore, the prices get updated, right? The information, which is very, very important for analyzing a stock, right? In a certain way, for me personally, I believe more important than studying the prices, right? The most important thing is to understand the ratios, the behavior, and everything related to the company. But the difference is, right, you will see that information coming either annually based on the fiscal year or quarterly. Here it's daily, or sometimes maybe in minutes as well, right? The prices will keep on changing. Even if you look at a monthly chart, yesterday's price, meaning if you look at the monthly candlestick based on the open high low close, obviously yesterday's data is different to today's data, the current data. So it always updates, it gets updated, right? So technical analysis is like that, where we look at the real mechanism of buying and selling with genuine real money, right? So I will invite you to have a look at this area just to study the behavior of candles, nothing else. And that will basically help you in your way forward regarding the learning of technical analysis. I think with that, I will end up today, hoping to meet you once again next week. Thank you very much.
Right. Thank you, Saliya. And so that comes to the end of the 4th session. And we will be again meeting you all next Saturday. I'm sorry, next Wednesday at the same time. So hope that you all got some good understanding about the OHLC analysis and about the fundamental analysis as well. And we will see you next week. Thank you. And the floor is now open for any questions.